Hello everyone. Today I'm going to discuss about capital market. As in this video I'm going to cover different components and functions of capital market, primary and secondary market, then different types of shares, preference shares, bonds, debentures, and basically capital market is used to raise funds from the market. So various corporates, government, they require funds for their regular need as well as for their long-term projects. So let's take an example. A particular company, they want to set up a new plant or they want to expand their current production, for which they require a capital of 100 crores. Now currently, if they are having only, let's say 20 crores in hand, and the banks are not giving a 80 crores of loan on the basis of their current financial situations. So here, if the company is having an opportunity to grow further, however, because of lack of funds, if they are not able to grow or they are not able to set up a new plant so that they cannot increase their production and ultimately the sales. They can see the opportunity, but they cannot capture it because of the lack of funds. So in this case, the companies or the corporates or even the government, they approaches a general public or the investors who can invest in their company by purchasing the shares, debentures, or bonds of those company, and they fund the company. Okay, so basically, capital market is the market where the companies, corporates, or the government they they basically sell. Sometimes they issue the securities of their own companies in the form of shares or bonds or debentures to the general public as well as some institutional investors. So simple, the capital market is a place where the companies or government can raise funds. At the same time, the investors or the people who are having a surplus amount of cash, they can purchase these securities in the with the view that they will get some profit. If these companies will get profit, then definitely the profit will get shared with the investors. Okay. So it's a win-win situation for both because the investors they are looking for the new opportunities for investment, and this capital market is basically making those opportunities available for them. So simple, the capital market is nothing but the place where the borrower and the lender comes together. So here we can say the security issuer or basically the companies who are issuing their bonds or debentures or equity shares, they are acting as a borrower, whereas the investors who are purchasing the securities or investing in those securities are acting as a lender. Okay. So it's a simple relation exists in the capital market. It's just a borrower and a lender. Now these are the features of the capital market where it connects the savers. Savers means the investors who are saving the money and looking, they are basically in a search of the opportunities for investment. At the same time, they are also bringing the entrepreneurs or basically we can say the borrowers who are looking for the huge amount of money for their projects. It deals with the medium to long-term investments. It presence of intermediaries and lots of intermediaries like the banks, uh, merchant bankers, investment bankers, brokers. A huge network of this institution is also exist in this capital market, who may be directly or indirectly involved in this fundraising activity as well as all transactional activities. So basically, this capital market is also regulated, and is the regulator is SEBI. Security Exchange Board of India is acting as a regulator for the capital market. And if the company wants to get registered on any of the exchanges like NSE or BSE, they have to first get registered with the SEBI. Okay. So in capital market, there are certain type of instrument where we can trade or we can only invest. Okay. So there are different types of functions of the capital market. Like the main function is to bring together the borrowers and lenders. So simple, the borrowers are basically the companies or government who wants to raise capital for their projects, and they are bringing together the investors who are basically looking for the opportunity for investments. So the investment can be go into a debt as well as equity instruments. The role of capital market. Again, they are basically helping in raising a long-term funds, but also they are looking developed for mobilization of savings. Because if the investors they are basically having a huge amount of money, but they are not able to identify the opportunity to invest. At the same time, corporates or the companies who are having a good ideas or good projects, but because of the lack of capital, they cannot able to carry forward those projects. So in the situation, the investors, if they're not finding any opportunity for investment, their money will not grow. At the same time, the companies who are looking for a capital for uh, basically increasing their production or starting new plants, so they will not get money. So they will stuck their project there only. So that's why the mobilization of money is required, and the capital market is creating this platform to all the peoples or investors so they can channelize or mobilize their money in a such a way that they will also get a good amount of return from their money, as well as the companies government they will get sufficient amount of money to run their show. So basically capital market encouraged to invest as well as saving more. They are in return they are giving a regular income in the form of dividend, bonus, interest, or coupons. At the same time, the capital appreciation means if they have purchased a share of let's say 100 rupees, so over the period of time, this 100 rupee share will grow to maybe 500, 1000. Okay, so it depends on the company performance. Okay, so these are there is unlimited profit as well as the losses to the investors. It depends on the how the company or the company or the entity where they have invested, how it is performing over the period of time. Okay. So these are the role of capital market that attracts more investors, more foreign investors. Okay. They're also providing the liquidity to the market because if the money is basically if it is stuck with some few investors and it is not flowing in the market, then there will be a slowdown in the economy. And to avoid this, the capital market is basically playing a key role. So advantage of the capital market is basically helpful to government as well as businesses to raise long-term capital in the form of equity shares or uh, by selling or basically by issuing the equity shares, preferential shares, bonds, debentures. Okay. They also create many jobs. So basically, ultimately, the capital market is not only useful in raising the funds, but at the same time, it helps to promote the growth of economy of any country. Okay. So that's why the capital market is more important, and everyone should know how capital market works and how they can get benefit from capital market investment. So before investing into capital, you should understand the disadvantages of capital market. Like the dividend tax is now it's not a tax deductible. Nowadays, there are tax rules have been changed. Then the rate of profit is generally low. Then expensive sources of finance for the issuers. Okay, and the market prices of shares keep fluctuating. So again, from investor point of view or the issuer's point of view, there are different disadvantages. So as an investor or as a fundraiser or issuer, you should know what kind of disadvantages of this capital market. Now, components of capital market. So capital market is basically divided into primary market and secondary market and the financial institutions. So financial institutions plays a key role in bringing the investors and the issuers together. Okay, and they are basically acting as a support function so that they can smoothly issue the shares, smoothly do all the transactions, all the money transactions will happen smoothly. So they'll ensure everything. So this structure will show you how this capital market is exist in India. Okay, so basically it has two segments: primary and secondary market. This primary and secondary market, where the different types of instruments are issued, like equity. debt, or even derivatives. And these instruments are also tradable. Okay. Now again, further we can say they are again divided into two segments, like wholesale and retail. Now in wholesale segment, we can see there are institutional investors like FII, DI. FII stands for foreign institutional investors and DI stands for domestic institutional investors like banks, brokerage houses, wealth management companies. And in retail segment, we have small investors, individual investors, HNI. So in detail, we can see that Indian capital market is divided like the primary and secondary, the instruments like equity, hybrid, debt, hybrid like mutual funds, okay, even derivatives, then intermediaries like brokers, investment bankers, stock exchanges, underwriters, the regulators, yes, SEBI, of course, and some key players like CRA. CRA stands for trade rating agencies, then corporates, intermediaries like banks or any NBFCs, then individual investors, banks, financial institutions, FDIs, foreign direct investments, and FIIs like foreign institutional investors. So this is a structure of the capital market in India. Now securities. As most already we talked, it's securities market. What is the securities market now? Now securities basically all the bonds, shares, scripts, stocks. They're tradable securities, or even the derivatives contracts are also the securities. Okay, so collectively we call them as securities, and the market where they are traded or issued, we call it as security market. Now the security market is basically issuing different types of securities. Now why we need a regulator? As the SEBI is acting as a regulator in the capital market, so to control all the transaction and the interest of the investors. Because if you see the scam 1992, where the loopholes of the system, as there were no regulator or even the regulator having a very less power at that time, and that because of that, many scams and frauds have been done. So that's why to avoid these scams, avoid the losses in the huge losses in the capital market, the Indian government have assigned a dedicated regulator for the capital market. And today, the SEBI is one of the best regulator in the world who is controlling Indian financial market as well as this capital market. Okay, there are some other regulators like Department of Economic Affairs, Department of Company Affairs, Reserve Bank of India, and the SEBI. So SEBI was incorporated in 1992, as you seen the scam 1992. So the SEBI was formed at that time only to protect the interest of the investor, to promote the development of security market, and to regulate the securities market. Okay, now participants in securities market are basically the investors, the companies who are issuing the securities, brokers, exchanges, intermediaries. Okay, so these are the participants. As the security market is divided into two parts, primary and secondary. The primary is basically whenever the companies or government, if they want to raise the funds to issuing the securities in the market, they are basically issuing their securities in this primary market. So the process of issuing the securities in the primary market is IPO. Okay, for example, when the company want to issue their stocks or shares first time, they come with the process of IPO. IPO stands for initial public offering. So in IPO through, they are issuing their securities in the market. Then once these securities are issued, these securities will be available for trading in the secondary market. Now, before going to the secondary market, we should understand what are the different types of issues available and why the public issue is important. As I told you that the companies, if they approaches to the bank, then uh, first of all, the loans will be given to the companies or even the government on the basis of their financials. Okay, past financials like balance sheets, profit and loss account. Let's say company wants to raise a huge amount of capital for their long-term projects, then they will not get the sufficient amount of money from the banks, and hence they come to the common public or even some institutional investors. From them, they can get a sufficient amount of capital. Again, they have to show that what is the uh, growth of the company in next few years. Okay, or they have to show the good performance of the company. So the issues are basically classified, or these are the public issues, IPOs, okay, initial public offerings, and primary market issues. So primary market issues are basically public issue, rights issue, and preferential issues. So in public issue, again there are two parts: the initial public offering and further public offering. So IPO and FPO. Now let's understand first what is IPO and FPO. IPO is basically when the company is issuing the securities first time in the market, so they come with the IPO. Okay. Now, if the company wants to raise capital again, they first approach to their existing investors. Okay, for raising funds. Okay, so they come with a rights issue. And through rights issue, they are basically approach their existing investor and they ask them to invest or purchase more number of shares. Okay, under rights issue. But if they fail to raise sufficient capital from rights issue, then they come with the further public offering. Okay, FPO. Further public offering also called as follow-on public offering also. Okay. Then there is a third category of issuance is preferential market. In preferential issues, companies are issuing shares to the selected number of investors. Okay. Now these investors are basically selected, or the group of person is selected under section 81 of the Companies Act 1956. And this is not a right issue or not a public issue. Now, once the shares are issued in the market, if they are tradable, then they are tradable in secondary market. So secondary market is basically the place where we can buy or sell already issued securities. So basically we do this activity on stock exchanges like BSE and NSE are the registered stock exchanges in India where we can buy or sell the shares of existing listed companies on these exchanges. Okay. So secondary market is basically providing a liquidity. They are providing the platform where the buyers or sellers they come and do the trades. Okay. Now the role of stock exchange, they are basically right now in last 20-25 years, the entire stock market or stock exchange, they are now electronic or computerly. It is connected with the computer and internet. So that's why it is very easy to buy or sell the shares through your demat and trading account. The capital market instruments, as we have seen already, that equity shares, preference shares, there's some non-voting shares, converting cumulative debentures. Okay, so various types of instruments are there. So let's see one by one. First of all, we are covering with the shares. Now, what is share? Share is nothing but the unit of ownership, interest in a corporation of financial asset that provide for an equal distribution in any profits, if any are declared in the form of dividend. So basically shares is nothing but the dilution of the ownership. So whenever a person purchases a share of any particular company, so he become a partial owner of that company. Okay. So share issuance is nothing but the dilution of the ownership. So there are two types of shares are generally issued, equity shares and preference shares. So let's see different types of preference shares. So preference shares, as we discussed, they are issued to the limited set of people. Okay. So different types of preference shares are like cumulative preference shares, non-cumulative, participating or non-participating, convertible or non-convertible, redeemable or irredeemable. So all these preference shares are having some of the benefits or features. So for example, if you look at the cumulative preference shares, so these cumulative preference shares, if the profit is not adequately generated by a company, so company will not be able to share the profit with the preference shareholder, because preference shareholder generally get a fixed amount of returns on their investment. Okay, or the dividend. For example, let's say 10%, 15% on the invested amount. Okay, so in cumulative preference share, if the company doesn't generate adequate profit to pay dividend to preference shareholder, so their dividend will get accumulated and it will get paid to next year or subsequent years where the company is generating a good amount of profit. In non-cumulative preferentials, if the company failed to generate adequate profit, then the preference shareholder will not get any amount of dividend for that particular year. Then we have a participating preference shares where okay, yes, okay, uh, yes, in non-cumulative preference shares, investors they won't get, or the basically preference shareholder they won't get the profit. Okay, if the companies doesn't produce adequate amount of profit. Okay. Third type is participating preference shares where they are entitled to share the surplus profit. So if the company is generating additional profit over some threshold limit, then this preferential holder will get some additional profit in it. Next category is non-participating, means the company do not share any surplus profit with the preference shareholders. Then we have a convertible shares where these shares will get converted into equity shares after a certain period of time. Then we have a redeemable preference shares where the shares can be redeemed after certain period of time. So let's say 5 years after issuance or 10 years after issuance. So it is up to the company. Okay, what will be the terms and condition of this preference shares? Then we have a different types of equity shares issued in the market. So equity shares, we have a general equity or ordinary equity shares. But along with that, there are some right shares, some bonus shares, some sweat equity or ESOPs. So we can see some of these as the share capital is basically divided into four parts. The first is authorized share capital, second issued share capital, subscribed share capital, and paid up capital. So these all four have a different meanings. As I discussed the right shares, when the company are issuing the shares to the existing shareholders. Okay? But in bonus share issuance, instead of company paying a dividend on their stocks or their company don't want to share the profit, but they want to give some benefits to the investors. So in that case, company issues the bonus shares. Now the bonus shares, let's say 1:5 for 5 shares, you will get one extra share and so on. And again, there is a sweat equity share. So sweat equity share is basically shares issued to the top performers, or we can say the executives or a top management company employees for their quality work or to retain them. The companies generally issue sweat equity share to them. There is one more category, ESOPs, ESOP. So employee stock options. So these are also issued to the employees for in the form of or maybe in exchange of their uh, incentives or bonus. Okay. Now, merits of equity share capital. Again, to raise a long-term funding. Again, there is no any fixed returns guaranteed on the equity shares or fixed dividend guaranteed. So that's why company have don't have any liability on their equity shares. Okay, they don't need to pay any interest or dividend on the capital raised through equity shares. So it's a helpful for the company. Whereas from investor point of view, there is a capital appreciation happen on the equity shares, and there will be a multiple or multi-bagger growth on equity shares. Now demerits, again there is no fixed amount of return on equity share. Again there is a loss of capital is also happened. Okay, so even sometimes the equity share is a costliest fundraising activity. So from both the side, from investor side as well as from issuer side, the equity share capital is one of the costliest thing or risky thing for them. Now here is the distinguish between the equity shares and the preference shares. So we can say the dividend rate for preference share is generally fixed, whereas equity share it fluctuates or sometimes the dividend is not given. Voting rights is always associated with the equity shares, but preference shares they do not have any voting rights. Again, we have participation in management. So preference shareholder there does not have any participation rights, whereas the equity shares holder they are having the participation rights. Whenever the company gets diluted, or we can say um, if the company is getting closed, then the preference shareholder will get the priority over the equity shares. Now there are non-voting shares as well as some DVRs, differential voting rights. So these shares they are not like the preferential shares where they are not having rights, voting rights, or maybe a very limited rights. Okay, the Tata Motors have issued their DVR, so you can check Tata Motors DVR. Okay, so different than a Tata Motors share. Now, when we comes to the debt market, so in debt market we have a debentures and bonds. Again, most of the time debentures and bonds are considered as the same, but there is a difference between these two. So bonds are generally used to uh, raise funds from mid-term to long-term, whereas debentures are used for short-term to mid-term fundraising. Again, the bonds are basically backed up with some physical assets like gold bonds, oil bonds. So these are physical asset in a backup. Whereas debentures are like personal loan, unsecured loan, where they're secured only by the promise of the issuer or the borrower, we can say. So this is a difference between the bonds and debentures. That debentures are basically issued by the companies or corporates, whereas the bonds are issued by governments or corporations. Debentures are generally unsecured. Nowadays, you can see the secured debenture also, but bonds, most of the time, they are secured. Debentures always carries a higher interest rate than the bonds. The characteristics of the bonds, they are interest paying securities, also called as fixed income securities. Okay, so they are carrying a fixed amount of interest, just like if you are keeping fixed deposit in the bank. So you have to pay, the bank will pay a fixed amount of interest on the capital invested in the fixed deposit. So similarly, the bonds, where the companies are or the corporates who are issuing these bonds, they pay a fixed amount of interest. Okay, in the name of coupon, okay, to the investors. So in bond market, the bond prices are changes as per the market interest changes. So generally, there is a inverse relationship exists between the bond prices and the market interest rate. As the market interest rate increases, bond prices will decreases and vice versa. Like if the interest rate increases, then bond prices decreases, and interest rate decreases, then bond prices increases. Generally, the interest payment on these bonds are semi-annually, but also you can find the bonds with the annual payments. Okay. There are different types of bonds issued, like one of the zero coupon bonds. They don't carry any fixed amount of interest. Okay. Or this interest is also called as coupon. Okay. So they are not carrying any fixed amount of interest, but they are sold at discount. So let's see some other criteria, like every bond is having a par value. Par value is the amount, or we can say the face value. Okay. Generally, par value is also called as face value, like 100 rupees face value, 1000 rupee face value. Coupon rate is nothing but a interest rate. Okay, and a maturity date, because every bond is having a fixed maturity date. As equity shares, you have found that they are not having any maturity date, but bonds or debentures, they are having a fixed maturity date. So government bonds, also called as sovereign bonds, also known as GSEC or gilted securities. Okay, they are generally mid-term to long-term and generally carries semi-annual interest rate. They may be taxable or may be tax-free. So it is mentioned in the government bond name. So for example, 6.25 GOI bonds or taxable bonds, GOI taxable bonds or tax-free bonds. It is mentioned in the name of the bond itself, whether the bond is tax-free or taxable. So the meaning of taxable and tax-free is basically the interest generated on the bond is taxable or tax-free, okay, and not the entire investment under section any ATC or tax deduction. You will not get in tax deduction, but you will get interest-free income from these bonds if they are tax-free. Then the corporate bonds, yes, generally there are two types of entities that issues the bonds. So the government, second is corporate. But again, there's a third category, that's banks and the PSU. They are also issuing the bonds and debentures. So different types of corporate bonds, like plain vanilla bond or a straight bond. Second, a zero coupon bond. Third, floating rate bond. Fourth, all these plain vanilla bonds is basically a regular bond. Second, zero coupon bond is basically the bonds are issued at deep discount. So, for example, a 1000 rupee bond can be issued at 300 rupees. Okay. Then the floating rate bonds, the bonds interest rate is not fixed. This interest rate is linked to some external benchmark. So let's say the interest rate is linked to the repo rate plus 5%. So let's say repo rate is 4%, then you will get 4 plus 5, that is 9% interest rate. If repo rate change, so let's say 3%, now the new rate will be 3 plus 5, that is 8%, okay, and so on. So bonds with some of the bonds, they are having some embedded options like convertible bonds. These bonds will get converted into equity shares or some other securities at maturity or maybe at described time. Then there's a callable bonds. The callable bonds is basically the right with the issuer of the bonds. They can call bonds at any time during the bond tenure. Whereas there's a puttable bonds gives a right to the bondholders to sell the bond at certain price during the time period or maybe a specific time. Okay, in the entire duration of the bond. Then there are some bonds are commodity linked bond like gold bond, sovereign gold bond, oil bonds. Okay, so they are commodity linked bonds. So some of the examples, yes, about the zero coupon bond, you can see the example like the IDBI Bank have issued their face value of 2 lakh bonds at just 5,300. Okay, it's a 25 years bond. So if you calculate the CAGR, so CAGR comes around to 15%. And the floating rate bond where the SBI have issued these bonds in 1993, where the benchmark is their 1 year fixed deposit rate. And over and above that fixed deposit rate, interest rate, they are paying 3% on these bonds. Now there are debentures. As the bonds, we can say the bond is a big brother of the debentures. The debentures is issued short term to mid term. So generally they issued for 1 year, when sometimes 2 years to 5 years or up to 7 years. Okay. Depends on the requirement of the issuer. Okay. So these are again having a different types of, or we can classify them on the basis of different views. So first point of view is security. So whether these debentures are secured or not secured or unsecured. So secured means they are backed up with some physical assets. So like debentures issued by Muthoot Finance. So they are generally backed up with some gold. Okay. Then from the point of view of tenure, so redeemable or irredeemable. So redeemable debentures, they can basically having a fixed maturity period, whereas the debenture irredeemable debentures, they are not having any fixed maturity. They are perpetual or lifelong. And from the point of view of convertibility, so convertible or non-convertible debentures. So these debentures may be converted into equity shares or not. Like coupon rate, so either they are having a fixed amount of coupon rate or maybe a floating rate, or they may not be having any coupon rate or zero coupon debentures. And last is basically on the basis of registration. So whether they are registered or bearer. So if they are registered on any exchanges, or they are just bearer, or they are issued only by the corporates without any registration. Okay, so these are the different types of debentures. Again, the last type of these uh, instruments or the fundraising instruments is foreign capital issues. As we have seen, equity shares, preference shares, or bonds or debentures, they are the instruments are issued in India. But the Indian companies can raise capital from foreign or outside India countries. So they can raise capital through euro issues or uh, issues like global depository receipts or American depository receipts. So let's understand one by one. So American depository receipts are basically physical certificate. They resembles shares. Okay, it's basically ownership of American depository shares. So they are nothing but a shares, but they are issued in America. Okay. So some of the companies who have issued their shares in America in the form of American depository receipts. So they are Dr. Reddy's Laboratory, ICICI Bank, HDFC Bank, Infosys, Wipro, Tata Motors, and Vedanta. Then there is a second category is global depository receipts. If you are issuing your shares or raising funds other than the America, so you have to issue a global depository receipts. So generally UK, in United Kingdom, you can raise the funds by selling or issuing global depository receipts. Okay. So Axis Bank, L&T, Mahindra and Mahindra, Reliance, and SBI have already issued their GDRs. Okay. So this is uh, all about the different types of fundraising instruments, and this is just an overview. Okay. So that's it. So thank you. And if you have any question, you can just put it into uh, comment section. So if you like my channel, then please subscribe, like this video, share it with your friends, and do not forget to click on notification icon or a bell button. Thank you.